My name's Taya Hallows. I work alongside Duncan Hughes at IFF. Today, I'm going to host this webinar on refinancing in renewable energy. Just to let you know, the webinar will run for 30 minutes, followed by a Q&A with Duncan, where he will be able to answer any of your questions. So throughout the webinar, if you just put some stuff in the chat, and we will be able to answer those questions for you.
So I'm Duncan Hughes. I've been in project finance banking now for nearly 40 years, in fact, working on some major project finance transactions. Of course, in recent years, we have had a big focus really on renewable energy, which of course is highly topical. And so we're going to have a brief look at renewable energy today. I've been working, as I say, in this field for decades now, and it's certainly a very interesting area. I think before we start talking about refinancing of transactions, it's of course important to remember that actually renewable energy projects are considerably more complex than, for example, a regular conventional energy type of project where we would have the project company special purpose vehicle, of course, as normal. We would have the EPC contractor who would build the plant, an O&M contractor who would operate the plant throughout the project's life. We'd have a feedstock supplier such as natural gas being supplied in there over a 30-year period. Critically importantly, of course, we'd have an off-taker under a power purchase agreement type of transaction, again for a 25 or 30-year period. And we'd have, of course, financiers such as banks. We'd have the developers coming in with equity and other types of financing. But actually, when we look at renewable energy projects, they're quite different, actually. I think it's important to recognize that renewable energy projects such as wind power, solar power plants, and so on are significantly different. And so, in fact, importantly, the original equipment manufacturer, such as Vestas, for example, in a wind power type of project, would actually be a primary participant in the transaction, usually engaging under a turbine supply agreement. And so the EPC contractor would be involved to build the balance of the plant, but a much more minor role than would otherwise be played. Also, we typically, with wind farms and solar parks, we need a sizable tract of land. So typically, or the ability to use an area of sea. So there would be a land or maritime lease agreement that would need to be in place ahead of time. So in short, a number of additional moving parts. Usually there would be a transmission agreement in place. Again, the power, for example, from a wind farm has to be evacuated into the grid. So there needs to be a transmission agreement. Very often we see export credit agencies supporting the original equipment manufacturers. And so in short, as I say, the transactions themselves are considerably more complex. And really that complexity in part comes from the ancillary and other infrastructure dependencies that we see with renewable energy projects. So most wind and solar power projects require backup facilities due to the intermittency of generation. Of course, the wind doesn't blow all the time, and of course the sun doesn't shine at night. So there is intermittency of of generation. So very often we need to have backup facilities in place to provide that energy and power generation when the wind isn't blowing or the sun isn't shining. Where we are with storage can mitigate this requirement, but of course, if we're adding a battery complex to the plant, of course, that adds a further level of complexity to projects. And as we saw just now, a transmission agreement is often required to connect projects to the grid. And this is normally the case. Normally, we find that the wind and solar projects are in relatively remote parts of the world. And so we've seen this recently in the United Kingdom. This is the Dogger Bank offshore project. So this will end up being a 3.2 gigawatt facility, but it's 130 kilometers off the coast of Yorkshire in the United Kingdom, and consequently that connectivity into the grid is also often required. So in some cases, similarly to conventional power, we get renewable energy sold to an electricity wholesaler under a long-term power purchase agreement. This is often actually with renewables under a different contractual structure. So that's actually important to recognise that the underlying contractual structures with renewable energy projects is often significantly different to that we would see with conventional. But nonetheless, that can represent an opportunity. So you get corporate power purchase agreements. For example, the big tech companies in the United States, Microsoft in particular, are looking at these corporate power purchase agreements where they're buying renewable energy directly from suppliers, and this is to comply with their Scope 2 emissions. Of course, Scope 2 emissions accounting, we see this now a requirement under the IFRS, International Sustainability Standards Boards, and other standards that require reporting on Scope 2 emissions, which is the emissions relating to electricity usage. And that corporate power purchase agreement is very often at a premium price to the market. But nonetheless, the credit quality of off-takers and their expected ability to stand behind long-term power purchase agreements, as with conventional energy, remains paramount. But I think quite an interesting phenomenon really relating to renewable energy is that very often electricity regulators would establish rules for the priority evacuation of renewable power. And therefore, so if you took even Germany now, Germany generates about 35% of its electricity from wind farms and other types of renewable energy. So if we considered that market and we had priority evacuation, then the truth is that you're going to be selling all of your renewable power into the grid, very often at a premium price. So it does beg the question whether or not one really wants to enter into a long-term conventional type of power purchase agreement based on a volume and market price kind of paradigm, rather than actually saying, okay, well, look, we're going to sell all of our electricity into the market. pretty much guaranteed, and therefore we're just going to rely on market sales. So looking at the capital structure of a project company special purpose vehicle engaged in renewable energy, of course, as with any company, the left-hand side of the balance sheet represents the assets in the form of a wind farm or solar park, potentially with ancillary equipment and services. And then, of course, as with any company, the right-hand side of the balance sheet is how those assets are financed. And so very often we see bank credit facilities sitting in that capital structure, usually from the very beginning at the outset of the project itself. Once the agreements are in place, the relative licenses, offtake agreements, and so on. So usually banks are involved from the very beginning of the project company's life, although not at the beginning of the project, as we'll see in a second. So particularly in today's project finance market, we see that the capital structures of project company special purpose vehicles generally evolve through time. So we start off with the sponsors of the project putting a small amount of equity in, excuse me, to develop the project. And that is kind of the seed money, really. Very often, of course, when projects are being developed, they don't actually go anywhere. The licenses that are required are not obtained. The project is not viable. So that's high risk equity that the sponsors would be putting in there. Then banks tend to get involved, as I mentioned earlier on, once the respective licenses are in place, sometimes providing in today's market an equity bridge loan, for example, which would provide funding to take the project to the next stage of development, but to be refinanced into an equity raise for the project. These tend to be quite popular these days, so there is a demand and desire for equity financing outside of that provided by the sponsors. And then we move, once we have the project up and running, then the banks initially will provide term loans and potentially other types of financing to complement the equity. Sometimes, of course, with renewables, there may be some grants or guarantees provided. But importantly, given the long-term nature of these project company special purpose vehicles, which might run for 25 or 30 years into the future, of course, banks are not going to want to keep, all else equal, a long-term facility on their balance sheet. So very often they'll be looking to refinance those initial facilities into a project bond. The good news for banks, of course, is that they can get additional fees for raising the money from capital markets. So how do banks do that? Well, the most common technique really since the global financial crisis and the demise of the monoline insurers, which actually made it feasible from a capital perspective for banks to provide long-term facilities to projects. But given the demise of the monoline insurers in the wake of the global financial crisis, in today's market, we generally see these mini-perm types of lending structures, which normally, as a rule of thumb, would cover the construction phase of a project, and then something like, roughly speaking, a 4 or 5 year period after the project is completed. Now, crucially importantly, the mini-perms have two principal types. We have a hard mini-perm and the project company special purpose vehicle and its sponsors, of course, who are typically the biggest equity investors, would take 100% of the refinancing risk. So refinancing would be required by a certain date, at which point the mini-perm would mature. And if the principal is not repaid to the lender at the end of that period, then an event of default would be triggered under the loan documentation, which, to be really honest, is not in anyone's interest to have that type of event of default. So in many cases, a soft mini-perm structure is used, and this is based around not a hard type of end date for the facility, but it's based around strong incentives to refinance. So the project company becomes subject to increasingly onerous financing terms, which will include things like an increase in the margins on the loans, more onerous cash sweeps out of the revenues to repay principal, and also potentially other prohibitions on dividends and other distributions to equity investors, including the sponsors. So it does become very onerous for the project company special purpose vehicle once we get past the initial tenor of a mini-perm. But banks need that in order that they can compensate for the additional capital and funding costs that would entail. Okay, so if you could have a look at the poll, which I believe has been launched, and if you could just please give your view on which structure, given what we've said just now about hard versus soft mini-perms, then we will take a poll from delegates. And while we're doing that, I will have a look. I think we've had some questions coming in. So let me have a look at the questions, and we will have a chat about those in a second.
Still people voting for now, Duncan, so let's just wait a minute.
Okay.
Right, I might end it, but we've got 77% on the semi and 23 on the hard perms, Duncan.
Thanks very much indeed, Taya, because that I think is what I would expect to see. That the soft mini-perms, although the terms become more onerous, the key point is relates really to flexibility. And Frank Decker made a very good point in his question coming in there, talking about intermittency and interconnection. And again, I think the reality of renewable projects is that the technology that we're seeing now, particularly relating actually to concentrated solar power parks, is actually changing quite significantly. And so that flexibility that the soft mini-perm structure would offer actually fits in very well where you've got this evolving technology. So it may be that, for example, after, let's say, 3 years of operation, where you've got a mini-perm in place that's going to last for, let's say, 7 or 8 years, it may well be that actually the technology is such that, for example, with concentrated solar power, that with the latest technologies relating to molten salt and to ceramic storage of heat within these concentrated solar power plants, that changes the whole nature of the project, and therefore the flexibility of a soft mini-perm, as reflected by the poll results, actually is generally favoured. Certainly, in my advisory work, my default recommendation has been to go with a soft mini-perm type of structure, because the hard mini-perm, as the name suggests, of course, must be refinanced. It would trigger an event of default, and it frankly leaves everyone in a difficult position. So that, I think, is quite interesting, that we see that result. So thanks very much indeed for those for that feedback on the polls. Abdul Rahman has a couple of questions here. First of all, talking about banks. Banks getting involved, which types of banks should be involved in renewable energy. Yeah, I think, development banks and state banking institutions certainly have a role to play. I was involved in the Lake Turkana wind power project in Kenya, which is the largest onshore wind farm in Africa, and that very successfully engaged under an A-B syndication structure. Both development banks, the African Development Bank was involved in that, but also a syndicate of commercial banks that came in under the multilateral development bank preferred creditor status. So actually there was a very, very successful transaction there, which involved development banks, who I think have an important role to play in this type of transaction. Abdurrahman's second question talks about how viable is phasing a project to make financing done in incremental terms. Yes, and I think this is actually a very, very important point. As he says, to give an example, a large solar power plant, it's an incremental kind of project. We see this, of course, in Saudi Arabia with the various phases of the NEOM project. We've already seen the line project, which now has scaled back its ambitions by 2030. So it's now only going to be 1.4 miles long rather than 190 kilometers. So actually, a very, very good point that Abdul Rahman makes, that it lends itself to a phased financing approach. And again, coming back to Frank's point about the incremental, about the terms and the soft mini-perm, again, the more flexibility that one has, which one has with a soft mini-perm type of structure, does make life easier in a relatively dynamic type of environment. And we've got also a question here talking about carbon.
Duncan, I think we've got lots of questions coming in. Maybe we should sort of save them to the end, maybe. Do you think?
Okay,
we've got
another one.
We've got a bit of content to go through still, haven't we? So.
Okay, fine. Very good. We'll come back to the other questions, as you say, at the end. Thank you. So yes, as we saw before the poll, the capital structure of project companies, special purpose vehicles, generally evolves through time in today's markets. So again, very importantly, when we're looking at the structuring or indeed viability of an equity bridge loan, for example, we've got to know or be pretty confident that there's going to be capital market risk appetite. And similarly, if we are looking at refinancing a mini-perm into a project bond, for example, then we need to be confident, of course, that there's going to be appetite there in the market. Of course, if we were refinancing or trying to refinance in 2008, of course, that would have been a significant challenge. So that requirement, and of course, we are looking here at periods of maybe 18 months to 24 months, and maybe a period of 3 to 4 years. Things change. They say that a week is a long time in politics. Well, at 3 to 4 years is a long time when it comes to project finance. So it does introduce a significant element of uncertainty into the financing, which, all else equal, of course, means that banks' pricing and also their capital requirements are going to both be higher. But on the other side of the equation, the good news is that there are opportunities, very significant opportunities in green bond markets. So if we look at the demand for long-dated green paper, currently as the market stands, the demand from institutional investors, mutual funds, and so on, greatly exceeds supply. So, of course, what that means is that bond prices are going to be high, given that demand exceeds supply. And of course, the corollary of that is that yields, and therefore the cost of project financing, is going to be low. So that's what we've seen. We've seen the compression of the green bond curve through time. And actually, particularly for investment grade green bonds. So those bonds with a credit rating of BBB minus or better, which more closely matches the risk appetite of liability driven investors such as pension schemes. We've really seen some very, very tight spreads over governments at the long end of the curve, which is, of course, where our liability-driven investors, such as pension schemes, life insurers, and so on, that's the principal place in which they would be looking to match their long-term liabilities. Right, I'll pause there, and we can come back to the third question on carbon capture and storage in a second. But any other questions?
I mean, there has been a couple of questions, I think. So, yeah, I don't know if you maybe just go on to the carbon one, maybe. That's fine, and we can then see what else comes through.
Thanks, Taya. Yes, so we've got, first of all, a carbon capture and storage company. So how do I suggest that we establish a mutually beneficial agreement that incentivizes the utilization of captured carbon dioxide while also providing credits from banks to users of renewable energy? And this is a very important point, because actually the utilization of captured carbon dioxide is actually really quite dependent on having ancillary facilities. So in America, for example, in the United States, they have a very well established pipeline network that can carry carbon dioxide, which needs to be very specific. Of course, you can't carry anything else in it. Actually, that was built to support the fizzy drinks business or the soda business in America. Otherwise, one needs to have localized carbon dioxide capture facilities, which can then really pretty much on site convert the carbon dioxide into limestone bricks or pellets or some other usable type of commodity. So yes, I mean it's a very good point that there can be an ancillary project to capture carbon dioxide, and of course increasingly we're seeing that that is another big area related to, of course, renewable energy. Quite a big question here in terms of how do I acquire financial loans from international financial institutions, because in Ghana here, the interest rate is very high for one to go in for. Absolutely right. I do a lot of work in Ghana. Actually, I'm flying out to Accra, in fact, on Saturday. I'm doing some work with the Ministry of Finance there. And yes, I mean, the yields, of course, on the government curve now in Ghana, given its triple C sovereign rating, of course, are sky high. So I don't have a very quick or easy answer to that question, but a properly and well-structured project that, if at all possible, can achieve an investment grade rating will give the best chance of attracting that financing, which again may be a combination of multilateral development banks such as the African Development Bank, EIB, and so on, along with commercial syndicates. In sub-Saharan Africa and other developing economies, actually commercial banks tend to like to co-lend with multilaterals, who, as I mentioned before, can lend their preferred creditor status to that type of project. Abdurrahman has.
Duncan, someone's just asked if you could go back to the last slide and just repeat the argument about the last slide. They were just not quite clear on it. I don't know if we could do that quickly.
Yes, sure. So the broadly speaking, there is as I mentioned, because of the demand versus supply of long dated, particularly long dated green paper, it greatly exceeds supply. It's really, I think it's really only project finance transactions in renewables that can deliver that long-term green paper that meets the requirements. So generally speaking, we're seeing a compression of the green curve relative to the government curves in most major currencies. But that's particularly the case, coming back to the last slide, where we've got our pension investors and life insurers, for example, that have long-term liabilities and therefore need long-dated assets with a tenor of 30 years or even more. And again, the relative quantum of supply of that type of paper relative to demand is such that yields are compressed even further at the long end of the curve, particularly where we've got investment grade ratings of triple B minus or better. So hopefully that answers the question on the long end of the green curve, where there is, because pension schemes, life insurers actually have sustainable investment targets to meet, and they have to allocate 10, 20, or even I've seen 30% of their assets to renewable type of investments, actually that means that demand is much greater than supply. So hopefully,
have we got time for one more? Maybe, Duncan. I've got one here saying, how do you get access to the bond? How do you get access to? I've just lost it now. How do you get access to the bond market as a project developer? Have we covered that, or?
Yes, I mean, really the role as a project developer. Normally, one would expect the developer to be working with an investment bank. So an investment bank would typically would play two roles. So again, in a typical type of transaction, what we would normally expect to see would be that an investment bank would get involved, pretty much in an early stage. So the sponsor or developer would kind of plan the evolution of the capital structure of the project company special purpose vehicle, which of course is an independent entity relative to the sponsor. But the sponsor, of course, will be a large equity investor. So really, the engagement should be as early as possible with an investment bank that would do two things typically. One, it would organize an original loan syndication. Very often, of course, given the risk, and Abdul Rahman makes the point about the high risk of these, usually bank facilities for larger projects are syndicated so that banks can spread the risk amongst themselves. And then the investment bank would play another role in the refinancing of a mini-perm or other structure into a project bond. And again, it would be the role of the investment bank to do that, to place the bonds with the market. So you'll see the league tables, of course, in terms of both loan syndications and bond issuance. Of course, you see in project finance, you very often see the big Japanese banks such as MUFG, Mizuho, Sumitomo, and so on are up there, along with the other major investment banks such as JP, BNP Paribas, and so on. But the Japanese banks tend to play quite a big role in this.
Duncan, I'm really conscious of everyone's time, obviously. I think maybe we should wrap it up then, but I just want to sort of thank you very much for your insights, and rest assured, everyone, we will be providing the notes, we will be providing the recording, and any answers to any unanswered questions we will be providing afterwards. So we will get to all your questions. And obviously, if you have any more questions about this or anything else, you can get in contact with us, and we will try and help you out and get you the answers you need. Thank you very much, Duncan.